The Intelligent Investor. The Intelligent Investor by Benjamin Graham, first published in 1949, is a seminal book in the field of value investing. Graham's philosophy of value investing, protecting oneself from substantial error and teaching oneself to manage the risks associated with investing, has made the book a timeless guide. It emphasizes investor psychology, minimal debt, and thorough analysis, prioritizing long-term strategies over short-term fluctuations. Warren Buffett, one of the most successful investors of all time, considers it by far the best book on investing ever written. Introduction. The core of Graham's investment philosophy is to make logical, disciplined decisions based on fundamental analysis, rather than reacting to market fluctuations or relying on speculative trends. He introduces the concept of Mr. Market, a metaphorical personification of the stock market's mood swings, to illustrate how an investor should remain detached from market euphoria and despair. Chapter summary. Chapter 1. Investment versus speculation. Results to be expected by the intelligent investor. Graham delineates between investing and speculating. An investment must be thoroughly analyzed, promising safety of principal and an adequate return. Anything not meeting these criteria is speculation. This chapter sets the foundation for the investment philosophy that prioritizes long-term security over potential high returns linked with high risk. Chapter 2. The Investor and Inflation Here. Graham discusses the impact of inflation on investments, emphasizing the importance of constructing a portfolio that can withstand the eroding effects of inflation. He advocates for a mix of stocks and bonds as a hedge against inflation, recommending that investors adjust the proportion based on market conditions and personal risk tolerance. Chapter 3. A Century of Stock Market History. The level of stock prices in early 1972. Although the specific dates and figures pertain to an earlier era, the principles derived from the stock market's history remain relevant. Graham uses historical data to argue for the cyclical nature of the market, encouraging investors to adopt a long-term perspective and avoid reactionary decisions based on short-term market movements. Chapter 4. General Portfolio Policy, the Defensive Investor. Graham introduces the concept of the defensive investor, focusing on minimizing risk and effort. He suggests a diversified portfolio of high-grade bonds and leading stocks, providing detailed criteria for stock selection that emphasize financial stability and dividend history. Chapter 5. The Defensive Investor and Common Stocks. Expanding on the previous chapter, Graham discusses how defensive investors can approach stock selection, emphasizing diversification and a systematic approach to portfolio construction. He outlines principles for choosing stocks, including focusing on companies with a long history of profitability and strong financial condition. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Criteria. Graham differentiates the enterprising investor from the defensive investor. The enterprising investor is willing to put in more time and effort into managing their investments. This chapter discusses what enterprising investors should avoid, such as speculative or popular choices, instead encouraging a focus on undervalued opportunities that require thorough analysis. Chapter 7. Portfolio Policy for the Enterprising Investor, the Positive Side. Focusing on opportunities for the enterprising investor, Graham suggests strategies such as special situations, bargain issues, and high-grade bonds. He emphasizes the importance of rigorous analysis and the willingness to look beyond popular stocks to find value. Chapter 8. The Investor and Market Fluctuations. Here Graham explores how investors should react to market fluctuations. He advises against trying to time the market or react emotionally to market movements. Instead, he advocates for a disciplined approach, using the concept of Mr. Market to illustrate the importance of detachment and focus on intrinsic value. Chapter 9. Investing in investment funds. Graham evaluates the pros and cons of investing in mutual funds. He provides criteria for selecting funds, such as management tenure, fees, and past performance, warning against relying solely on past success as an indicator of future performance. Chapter 10. The Investor and His Advisors. This chapter emphasizes the importance of choosing advisors wisely, recommending that investors ensure their advisors are not merely speculators. Graham suggests questions to ask potential advisors and the qualities to look for, prioritizing those who understand and adhere to value investing principles. Chapter 11. Security Analysis for the Lay Investor. General Approach. Graham outlines a simplified approach to security analysis for non-professional investors. He stresses the importance of financial statements, advising investors to focus on long-term earnings power and the stability of those earnings. Chapter 12. Things to consider about per-share earnings. Graham discusses the nuances of earnings per share, cautioning against overemphasis on short-term earnings. He argues for a more nuanced analysis that takes into account earnings stability, the quality of earnings, and the broader economic context. Chapter 13. A comparison of four listed companies. Through a comparative analysis of 4 real companies, as of the book's latest editions, Graham illustrates his principles of investment selection, highlighting how different factors such as earnings stability, dividend record, and financial strength play a role in assessing a company's investment potential. This chapter serves as a practical application of Graham's theories, demonstrating how to apply his criteria to real-world examples. Chapter 14, Stock Selection for the Defensive Investor. Graham presents specific guidelines for the defensive investor in selecting stocks. He emphasizes criteria such as a consistent dividend record, financial stability, earnings growth, and moderate price-to-earnings ratios. This chapter is crucial for investors seeking a low-maintenance approach to stock selection that still adheres to the principles of value investing. Chapter 15, Stock Selection for the Enterprising Investor. For the more active enterprising investor, Graham discusses strategies for identifying undervalued stocks that may require more research and carry higher risk but offer the potential for greater rewards. He covers different categories of stocks, including growth stocks, turnaround situations, and relatively unpopular large companies, providing a framework for analysis and selection. Chapter 16, Convertible Issues and Warrants. This chapter delves into more complex securities like convertible bonds and stock warrants. Graham outlines how these can fit into an investment strategy, explaining their potential benefits and risks. He advises caution and thorough analysis when considering these instruments, as their value can be significantly affected by market conditions and company performance. Chapter 17, 4 Extremely Instructive Case Histories. Graham presents detailed case studies of specific investments, including both successes and failures. These real-life examples illustrate key principles of value investing, such as the importance of margin of safety, the dangers of speculative mania, and the value of patience and discipline in investment decision-making. Chapter 18, A Comparison of 8 Pairs of Companies. Expanding on the comparative approach of Chapter 13, this chapter examines 8 pairs of companies to highlight the factors that can make one a better investment than the other. Graham uses these comparisons to reinforce the principles of fundamental analysis and the importance of qualitative factors in stock selection. Chapter 19, Shareholders and Management's Dividend Policy. Graham addresses the relationship between shareholders and company management, focusing on how dividend policies can affect investment value. He argues for the importance of dividends in the total return on investment and advises investors to consider a company's dividend policy as part of their overall assessment. Chapter 20, Margin of Safety as the Central Concept of Investment. In the final chapter, Graham emphasizes the concept of margin of safety, purchasing securities at a price sufficiently below their intrinsic value to allow for error in the estimation of that value. This principle underpins all of Graham's strategies, serving as a buffer against the unknowns and uncertainties of investing. He argues that adhering to this principle is the key to successful investing, providing protection against loss and the foundation for consistent investment returns. Conclusion: The Intelligent Investor remains a cornerstone of investment literature, offering timeless wisdom for both novice and experienced investors. Graham's principles of value investing, emphasizing fundamental analysis, discipline, and a long-term perspective, continue to guide investors in navigating the complexities of the stock market. By adopting Graham's strategies, including the crucial concept of the margin of safety, investors can work towards financial security and success in their investment endeavors.